Hey, everybody. Thanks for joining today's episode. My name is Chris Harris, a certified financial planner. And today we're going to be talking about some of the biggest retirement risks that retirees face. And guess what? It's not necessarily a market crash. Um, as a disclaimer, this video is for informational and educational purposes only and should not be considered investment tax or legal advice. So, when we think about retirement risk, I think a lot of people generally go to market crashes, right? That's just generally because it's in the news. We look at history and we look at like the great financial recession and those type of things, and that can definitely have an impact on our retirement. But there are some other things that I think it's important to look at in terms of risk. Um, and I think these are often overlooked because, again, it's not in mainstream media. And I think some of these concepts are pretty confusing. So we are going to talk about a few of these risks in retirement. And I see a lot of these as a financial planner, but we're just going to start off with some of the main ones here. So we have risk in retirement. So the first one we're going to talk about is sequence of return risk. So this does have to do with the market, but we're going to dive into that because it is a really important concept, I think, to understand in terms of your portfolio and when those withdrawals start, and kind of how that how the market cycle, if you will, impacts that. Um, the next one is withdrawal, and this kind of ties into sequence of return risk. So we have withdrawal risk. So we kind of have that staple or that, the rule that the 4% rule. We've probably all heard that. So we're going to talk about that, kind of where that comes into play. But if we have withdrawals that increase a certain level, that can have a huge impact on our retirement outcome. The third one is inflation. Um, and I'm not going to talk about this one directly, but inflation risk is important to understand. And when we project things in terms of retirement outcomes and assumptions, we want to make sure that we have inflation and cost of living adjustments and things like that, baked in, so that we can kind of get a picture of, kind of the future and what we anticipate in terms of inflation and the cost of living and all those different things, because that will have a big impact on, when retirement, if you need to withdraw more because inflation is high, things cost more. You go to the store, groceries are more, gas is more, those type of things. That can really hinder and have a big impact on a retirement portfolio. And then the last thing that we're going to talk about is age. So this one actually is probably one of the most important things that we talk about, because if we totally neglect on how long we think we're going to live. So for example, if we think that we're going to only live till age 70, but we live till age 90, that can have a huge impact on the withdrawal strategy and the overall portfolio, and if that can last as long as we're alive. And so understanding age is a huge piece of retirement planning. The age on how long we think we're going to live, and we don't know how long we're going to live, but that's really where these assumptions can be powerful, because we can put in different assumptions for our age, and we can live till 100 or whatever, and really plan for kind of the worst case scenario, which would be outliving your portfolio. So age is a really important thing, and it's also a big risk. So let's dive into this. The first one we're going to talk about is sequence of return risk. Now, this chart can look a little daunting, so I'm going to make it hopefully easy to digest here, but just to make it simple. So this is 4 portfolios. So we have 4 portfolios starting at $100,000. Each portfolio is based on an average return of 6% over 30 years. Okay. And then uh, we have a bull market first. So this dotted line is a bull market first, and then this dotted line underneath it is a bear market first without any withdrawals. Okay, so these two portfolios, the dotted line portfolios, have no withdrawals. They're identical portfolios. However, they just have differences when the bull and the bear market occurred in that path. So for a bull period, we have 27 years of 8% annual returns, and a bear period, we have 3 years of negative 12 annual returns. So we have a negative, okay, for 3 years. So as you can see with these first dotted line portfolios, this top one is the bear market. We start out with the bear market, and then the end of the last 3 years of this portfolio, it has a bear market. So we have negative 12% annual returns for these 3 years, and they converge. These two portfolios converge at the same ending value. Okay, so they're identical. They just, when the bear market occurred versus when the bear market occurred, are different. Now let's take that, if we now start adding in withdrawals, and this is where retirement planning becomes very important, because if we have withdrawals happening, so in this situation, this is a 60-40 portfolio, and we are withdrawing 5%, if I can use my stylus here. So 5% withdrawals for these two solid line portfolios. So the first portfolio, we have $100,000, and we have a bear or a bull market first. Okay, so we have positive 27 years of 8% annual returns, and you can see that the portfolio is doing great. But every period, we are withdrawing 5% of the portfolio. So at the bear market, once we transition to a bear market, we actually end up being positive. We have a positive value in our portfolio. Okay, so we made it out okay. We still have funds that we can withdraw if we have not passed away by then. Okay, we have an ending value, if you will. Now let's take the other portfolio. We start off with a bear market, but we start our 5% fixed return just like we did with the other portfolio. And we then have a bull market. So the bull market, but the problem is we're still withdrawing 5% of the portfolio. And as you can see, we actually end with 0 before end of life. Okay. That's the sequence of returns. So we can't time the market, we don't know, but that's really where asset allocation, diversification comes into play, but then also understanding our withdrawal strategy. So we can't just say, well, we're going to draw 5% during a bear market. We may need to modify and supplement if our portfolio is really taking a hit, because over time, we can see that to catch up becomes next to impossible, because we have already withdrawn enough of the portfolio so the portfolio doesn't have legs to stand on, if you will, to keep compounding through those periods. So that's why it is very important to understand sequence of returns, but it's also really important to understand how the withdrawal strategy can impact your portfolio based off of market conditions. That kind of ties us into the maximum withdrawal rates in retirement. So these are maximum withdrawal rates over a 30-year retirement period based on a historical 60-40 stock bond index. So we have the orange is historical maximum withdrawals, and then the solid estimated maximum withdrawal rate. So if we look at this, this is interesting, and I think the big thing to focus on here is looking at the minimum, which is 4%, and this is where we got that minimum 4%. So you can see over time, obviously the withdrawal rate has fluctuated quite a bit. But what we're able to see is that if, depending on when you retired, if you stuck to a 4% withdrawal rate, you were able to survive even those, pretty rough periods. And that's really where that minimum 4% comes, is that, feeling comfortable from a historical standpoint to look at the data and say, yeah, we think, based off the historical patterns, 4% should be a good number. However, we see that the average throughout the period is 6.9% withdrawal rate. So we actually have a little bit more room to run, but this is really where it becomes important to understand the really the size of your portfolio, if it can support your needs, what you're trying to accomplish with your portfolio, if you want it to, leave assets to heirs, if you want to do philanthropic things, if you want to just take it and spend it. So there's a lot that goes, into play when we talk about withdrawal rates. Obviously, and then, sequence of returns also comes in as well, based off of where we're at in the market. And if we can continue to allow the portfolio, kind of that growth, without depleting it with a higher withdrawal rate. So something to keep in perspective. This isn't a one size fits all, but it is very customizable to your own needs, your own goals, and how your portfolio can, weather, a different withdrawal rate. um, and then we have life expectancy. So this is U.S. life expectancy. So we have the 90th percentiles here, on the top with these dotted lines. Um, and then we just have the normalized amount with the solid lines here. So you can see here that folks, if just by looking at the lines, we definitely are living longer, and even the 90th percentile lived to 93 and 96 for 40-year-old men and women. They're expected to live to 79 and 83, whereas we see, for 65-year-olds, life expectancy is 83 for men, 83 for men and 86 for women. 90th percentile are in the 94 and 97. So that's kind of where we start to say, okay, how long do we think we can, live, and still enjoy our or our portfolios, right? Because again, if we say, well, I don't think I'm going to live past 70, but then you live till 80, that's 10 years of portfolio, withdrawals that you potentially are going to be needing to take. So again, that's really where we start to look at the numbers and say, well, okay, based off of the statistics and really where we're at, where do we feel like we should put that longevity age, right? Is that age 90? Is that age 100 to be conservative? And again, we look at, whether it's parents, grandparents, things like that, that really help come up with those numbers, and hopefully, make, a solid kind of runway, if you will, for retirement assets living up to whatever age, we project. So just something to like put in, kind of that back of your mind as you plan for retirement, or if you're in retirement, you've started out in retirement, you want to make sure you kind of understand how long are these assets really going to last me. The main thing that I think we want to concern ourselves about is not running out of assets if we outlive the portfolios, right? So just it's a major problem if we underestimate some of these assumptions. Okay, so the last thing that I wanted to show, and this is more of a statistical measure of sequence of return risk over a rolling 25-year period. So we have a 76 rolling 25-year retirement period. So this is from 1926 to 2025. We have two different portfolios here. And we can see that if this is the top one here is a 100% concentrated large cap portfolio. Okay, so very concentrated, 100% large cap. And this one is a 60-40 diversified portfolio. Okay, so each scenario, we had an initial investment of $1 million and a 6% initial withdrawal, and then a continual 6% withdrawal. So as we look at this, so different time periods, so we look at just the 10-year time period from retirement, it looks like things are going really well initially, right? So we have this gap about 8 years. And again, each one of these lines represents a different period of when you start your retirement withdrawals. So as you can see, we already start to see portfolios go to zero. So these lines go into zero. Okay. That means you deplete your portfolio. Um, and then more on, more here. So it looks like we're just picking up steam with more portfolios going out. And then versus the 60-40 portfolio, as you can see, it looks like every portfolio from that time period, again, these are historical, 76 rolling, 25-year retirement periods. That 10-year period, no portfolio goes to zero. We do have some that go later on, right? But we do see that a lot of portfolios do end up succeeding. And again, there's a lot of assumptions with these. Just trying to illustrate the power of diversification, because a lot of times people just focus on the annual or expected return. And that's really where we get folks highly concentrated into like the S&P 500, right? And in retirement, that can be detrimental to your withdrawal strategy or retirement living. A lot of different aspects of retirement it can have a huge impact on, because of just this here, like what we're talking about. And so that's where diversification comes into play. And really what we're looking at is from a statistical standpoint is looking at to smooth that experience in retirement in terms of the returns, but increasing the probability that you can have cash flow, and making it to the end of your life with that portfolio, right? That's kind of the goal. So we look at expected return kind of differently. Instead of saying, yeah, we want higher expected return, but that comes with greater volatility, right? A greater standard deviation, which can really have an impact on your portfolio, especially when we're starting those withdrawals, how much we're withdrawing, as we saw in that previous sequence of return slide. Because if we start out in retirement and we start this withdraw strategy, but we're in a highly concentrated large cap, and we drop 20 30%, whatever it is, that can have a huge impact on our portfolio, as opposed to a diversified, properly allocated portfolio that could weather some of the storm and maybe not drop as much, and so those withdrawals won't have as big of an impact on the overall portfolio. So there's a lot that goes into that, but I just wanted to show this kind of side by side to show you that, again, it's the sequence of return risk is important to understand, and that's really where we start to diversify, to start to understand, again, goals, timeline, meaning time horizon to retirement, time horizon to the end of our life expectancy. And so those things, putting those all together, we can start to understand, okay, inflation, withdrawal strategy, cost of living adjustments with Social Security and other benefits that, may be impacted by inflation. So understanding all of those things, putting it together, really becomes powerful for the retiree, so that they're not just left with, I guess, this concern about, well, am I really going to make it to retirement? Well, you got to put all the pieces together, and then you can start to kind of formulate a better path to knowing whether you're going to make it or not. So I hopefully, this hopefully it wasn't too, I didn't want to go too technical, but again, I think some of this stuff does get kind of technical. And I think looking at historical data can really help put things into perspective for the future. Even though, we look at, there's no expected, future performance, because nobody can predict the future. But I think it is important to understand historically kind of how things worked and what withdrawal strategies worked in different market situations. So again, hopefully that helped. Hopefully that gave you a little bit more perspective into understanding some of the bigger risk in retirement, aside from just focusing on the daily, moves of the market, but the bigger picture and how that can impact a portfolio. Thanks for joining. I hope you enjoyed the video. We'll catch you on the next one. Thanks for watching. Please feel free to DM me if you have any questions or concerns. Thanks.